Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was reading through some comments. I can't remember if it was YouTube or Twitter, where they said if I could describe some of these charts, kind of what the relationship is when it's a ratio chart, and like the PPI to CPI ratio, and some other things. And what I did is I put together, I know I've got this thesis. I'm going to describe the thesis a little bit again, using the charts, and kind of described how I came about using it, or found basically these correlations. What I did is I went and looked at the charts, and then I try to find evidence and work backwards from the charts. I don't create a thesis and then try to make the data work. I look at the data and then develop a thesis from the data. So I'll look at all these charts. I'm going to help describe my opinions, and maybe it'll resonate with you. Hopefully what it can do is it can get you a paradigm to look at the markets through a certain way that maybe you've never looked at it before. And I'm going to try to explain it as best I can, and we'll get in here, and I'll give you my opinion. So let's just dive in. I'm going to start with this chart. I think I put them in a good order for going through this. What this is the M2 money supply divided by the gross domestic product. So what this means is it's the money supply in relationship to the total things that we've built in society. And all the way from the 1960s, we basically had an M2 money supply that was relatively stable against the GDP. So we would increase the money supply, but GDP grew with it. In fact, it grew at a faster pace over certain periods, and it would oscillate back and forth between a ratio of about 0.6 and 0.55. So it was going back and forth in a controlled manner all the way till about the mid-90s. In the mid-90s, we really hit a boom in relationship in GDP. So GDP was outgrowing the M2 money supply during this time frame. In the 1990s, late 90s, 99 and 2000, things changed, where the money supply started to grow more rapid than gross domestic product. So we were coming up, and we're in this large uptrend where we haven't seen this, we'll call it instability in the market before. And what this is it's money being created at a faster pace than GDP ever since the year 2000. We've been in an uptrend. We've broken out of the old downtrending pattern. We broke out, did a retest, and now we're launching in the 2010s and 2020s. Now, this M2 money supply, it's got to go somewhere. They're creating it, and it's going somewhere. They could be buying bonds with it. They could be buying stocks with it. It's in the system, and it's going to be inflationary. So what this is telling us is that the M2 money supply has been growing more rapidly than GDP, and it's somewhere in the system. It's out there. Now, what's happening is that money enters the system, and depending on where the market conditions of the system, the money flows to certain areas. So we know that we have more money. We just don't know where it's at this time. So the M2 money supply has been outpacing GDP. It's in the system, but we don't know where it's in the system right now. So we go to the next chart, and what this is the commodity to S&P 500 ratio. We know that they've been creating money, and in relationship to GDP, it has been inflationary. It should be. But why is it not inflationary? How come we're not seeing this M2 money supply in the CPI? Why is it not in the consumer price index? Because the money isn't, quote, into the system circulating. This here is the reason that velocity is also dropping so rapidly. They're creating money, and they're keeping it basically in the banking system or somewhere else, like in investment banks or the Federal Reserve, or somewhere it's in the system. Now, when you look at the commodity to S&P 500, we've been in a market condition from 2008 in a disinflationary environment in a recovery phase where money wants to rotate into stocks. We can see it clear as day when you look at the commodity to S&P 500 ratio. It's been going in a downtrend, and this area down here is the cheapest commodities have ever been in relationship to stocks over hundreds of years. So where that money went, this money here that was created went into stocks. They went into the S&P 500 and NASDAQ. How do we know that? Because everything else priced against stocks is cheap. Or yes, is cheap against stocks. So everything when priced against stocks is cheap. So stocks are expensive against everything. And this is just one example using commodities. Stocks are expensive against real estate. Stocks are expensive against gold. They're expensive against absolutely everything. And this is how we know that. This here is basically telling us the market conditions that we've been under, which is a disinflationary low interest rate environment. It basically crowded all the money into stocks. This recently has broken out of its downtrend line. Stocks outperformed during this period and money went into stocks and not into commodities. We broke the downtrend line and a new paradigm where commodities will outperform. Now, what's different about this cycle is we've never been out of balance this far to the downside, and we've never had this much money in the system before. We've broken out, and we basically have a problem. The problem is that they continue to make more money than GDP. Call it a debt problem, a debt crisis, whatever it is. Now, what happens here is this is an accounting mechanism. The commodities, when they go up, is an accounting mechanism for money in the system under certain market conditions. And when when the commodity index goes up, it's going to basically flash everyone a signal that the money exists in the system now. It's not just tied into stocks. It's going to come out of stocks and bonds and rotate into commodities. But commodities are a visual. We'll call stocks and bonds like females. It's got the money, it's in the system, but it's all kind of hidden in the system. Their emotions are hidden this time. Commodities, we're going to call them, we'll call them males. All right. They don't keep secrets very well. They're gonna brag about their conquests. It's going to be seen. It's going to come into the system when that money rotates into commodities or into commodities. The consumer price index will see it. The producer price index will see it. So the money's in the system. It's just not seen when it's in stocks because it inflated a bubble in stocks. But that money's all going to rotate and come into commodities, and it's going to be seen. The thing that rotates the money is the housing starts and the lending in the system. Every time we go into these big booms in real estate, it's inflationary and interest rates pop up and all this other stuff. The 70s and 80s, this is the 2000s boom, and this is a boom that's coming right ahead of us. And during these booms, we had big expansionary phases of real estate. If we're going into a boom, we should see the home building index do quite well. And what do we see? We see the home building index in a consolidation phase from 2008 all the way till the breakout of 2020. We've broken out. We're doing a retest move, and we have a bullish engulfing pattern. You've heard me talk about bullish engulfings quite a bit. This I do think will go higher. It's got a broken downtrend line, and it's going to take some time. And we're gonna oscillate. This housing starts are going to oscillate above the average for a while. However many they can build, supply chain constraints and whatever constraints they're facing. But it looks to me like this isn't a bull market, and that we're just starting off and kicking off a big bull market in home builders and housing starts. Those are the market conditions for this money to rotate into commodities and away from the S&P 500. You can see that we've broken the downtrend line, and that paradigm has already started because we've gone into an expansionary phase of real estate. Everything that I'm talking about is all interconnected. It's all interconnected. And what we've got here is the PPI to CPI ratio. This is the producer price index versus the CPI. Consumer price index is the index at the tail end of things, and producer prices is the costs of those things being produced. Cost coming in, which is your inputs, and then CPI is your outputs. What happens in the beginning is the PPI will start to outpace the CPI, and you start to come upward. And what that means is that the PPI is going up at a faster pace than the consumer price index. So we go into this large upward move where the PPI outpaces the CPI. The producers are starting to eat the costs and margins start to decrease. As the CPI starts to normalize, this should go sideways to slightly lower, meaning that the consumer price index will start to outpace the producer price index. And that's kind of the cycle. We also had the same thing. We had a massive producer price index outperforming the CPI, and then the CPI caught up, and the producer price index started to go lower. Now we're in another cycle, an up cycle. We could break out of this channel, this upper trend line to the upper upside, meaning that the producer price index is continuing to beat the CPI at ever increasing paces. And that could be a new, it could be something that is telling us that we have too much money in the system, and that money is now being accounted for. Going back to that first chart of the M2 money supply in relationship to GDP, now the money's being seen in the system here. That's why it's going up so much, is because all of that money was tied into bonds and stocks. And now the producer price index is catching a whiff of all of it. So it's got the right market conditions of real estate for the money to be loaned into the system and seen in the system, and then all of that money rotating back out of stocks and bonds into commodities. These are all in alignment. This is the S&P 500. These are the expansion phases of real estate. They're in these consolidation periods. I am saying that we're going into a new expansionary phase where the stock market's going to go into a consolidation period, just like it did from 2000 into about 2009 is where it bottomed, and then we broke out of that channel. These expansionary phases are tied to the PPI to CPI ratio. When this goes up from 72 all the way till about 1980, when it started to decline, stocks don't like from 72 to 1980. 72 is in this vicinity here to 1980, which is over in this right-hand corner here. That's the period of the expansion phase of real estate, and when this producer price index to CPI also. What happens is these margins contract in this time period for stocks. Their margins contract, which is the difference between PPI to CPI. Their margins are contracting here. This is basically what it's telling us. The PPI is outpacing the CPI where the margin contracts, and now the margins try to come back. This is margin expansion as this drops. Margin expansion is great for stocks. So from 1982, when this started to decline, all the way till about 2002, we saw a gigantic bull market in stocks. So that is from 1982 all the way till the year 2000. The year 2000 was in this general vicinity when this started to come back up. All of this is interconnected, and what I'm using this for is a roadmap. It's our leading indicators of what the markets should be doing, and then we can look at the S&P 500 and validate. We can look at ratios and home building index and all these things to validate it. They are all interconnected. Here's the Dow Jones to gold ratio. In 1913, right here, when it was super stable back here, the Federal Reserve went into power in 1913, and look what happened afterwards. All of this garbage. This here is a way to basically profit from the system from boom and bust cycles. The expansion of credit and the destruction of credit. The expansion of credit is the downward moves in gold outperforming Dow Jones. In the contraction or recovery phases are the ones there where they go back up. Big booms, big busts. Big booms, big busts, and I think this is going to bust lower based on how much money is in the system and where we are in the real estate cycle. Then we use our ratios to find where value is. Oil, you should have been buying oil in 72, 73. You should have been buying oil anywhere basically around 30, wherever possible. And then it would contract. This is 98, 99, and it would contract all the way down to below 10. 10 is expensive for oil. Anything above 30 is dirt cheap. This was the absolute anomaly of oil, where we should be buying the heck out of oil. This was an opportunity here, guys. And if you notice, we've got an uptrend line that we've broken to the downside in oil. This is probably going to come up and do a retest, and then we're going to compress again. Oil had a consolidation period. We can see it using chart patterns. Our buy point was in 99 here, where the circle is, and our sell point was in 08. 2008, we compressed all the way down to the bottom here, and there's our 1999 buy point using ratio. So that is the same as ratio investing. It said buy here, sell there. It gave us another buy signal all the way down through here. We had our consolidation period. The consolidation period was from 2008 to 2020. I'm going to go back. 2008 to 2020 is the bottom of stocks all the way to the top of up here. If we go back, 2099 was here. We should have been buying commodities, and then 2008 is the peak here. The PPI to CPI also agrees with this information. 2008 all the way down to 2020, we could see the consolidation in the PPI to CPI ratio. Does this chart look similar to the way that oil is behaving? Now, which one's the driver here? The driver is oil. Oil is driving this chart. Oil is driving these phases in here. What happens is you go to an expansionary phase where money gets kicked up. More money gets put into the system. It puts oil into a shortage, and it goes on higher. All that money. It's more money chasing fewer goods, and goods are nothing more than a derivative of energy. It's a derivative of oil. So that there is what's driving this bus, and we've got problems in energy. And I think that we're going to see the producer price index, much like Germany's, rocket higher even more so. I think we're going to break out of this because of energy crisis in the world. That's what's driving this bus, and I think that we're going to see a bigger stock market decline than what most people think. More than normal, I should say. And this is our monetary base to gold ratio. Another thing I wanted to explain on this. So this is how much money's in the system in relationship to how much gold is in the system. So it's basically the price of gold in relationship to how much money. This here is nothing more than a derivative of oil. It's a derivative of oil. It's a derivative of your monetary base and your CPI. Your PPI here, your PPI to CPI ratio, when this is going up like this, whenever this goes up, that is when you're going to see a revaluation in the monetary base to gold. This is going to account for it. The 1970s is this move here, and then the 2000 to 2008 move is down here. Notice how this move is much smaller, and this move is gigantic. We had an energy crisis in 1970 in this move over here. We had lots of money and an energy crisis. We did not have an energy crisis in this area here. Oil did go up, but it wasn't a crisis level. What could potentially happen is we get a 70s type move because we have a worldwide crisis in energy, and people are going to get afraid of currencies, of the inflation in the system, the CPI being so high. And that's what I'm waiting for, is that fear that this monetary base to gold is just a derivative of oil and the energy costs in the system. It's oil, natural gas, and whatever else. And it's going to take time to solve those problems. They're not going to be overnight. It's not going to be quick. So I think that a similar scenario market conditions is going to be like the 70s, where we're going to have a big revaluation in gold in relationship to the monetary base. This here is extremely cheap. Another cheap one is XAU to gold ratio. So gold is cheap to the monetary base, and then the gold and silver miners are cheap to gold. So this is a multiple leverage bet where the miners could increase against gold at the same time that gold is increasing against the monetary base. And you can use silver and all these other ones too. But this is also an opportunity. And I know I kind of drew this in somewhat sloppily, but it doesn't matter because it is consolidating and coming to a point where we're about to break to the upside, where the gold and silver mining companies are going to outperform because we have the right market conditions. This is the platinum to gold ratio. We had some ridiculous, this is ridiculous. They were holding the price of gold down. Platinum, they weren't. And then they basically released the hold, and gold had to account for that money in the system. I think another one's going to come. You can tell that anything below, we are below, look at that, 0.51 is cheaper than all the way back to 70 when gold's freely traded. Platinum's never been this cheap in history all the way back to 1971. If you look at the bull market of 2000, so 99, 97, it was early, platinum outperformed gold all the way at the beginning of that bull market, all the way up to over 2.25. We are we're at 0.5 right now, and we could go all the way back up to a ratio of above 2. That's a 4x against gold if platinum were to do that again. And there's the break of the upside of the pattern and then the pullback. I'm just showing you different ratios and setups and how things are breaking. This is also signaling that we're going into an inflationary period, and that things are going to be different going forward. That's what that break of that pattern is. And everything I show you on this channel and on the website and all that stuff, they're all interconnected. Everything is interconnected. There's a reason I'm showing these things. They're all saying the same thing. Everything's saying the same thing. It's not a surprise that the margins are shrinking in the NASDAQ and the S&P 500 companies. It's not a surprise that oil is going higher. It's not a surprise that all of these things are shifting and moving the way that we already know they should shift based off of this information. If you look at the data and go backwards, you're going to get some information. Now, there are some things I want to talk about in a recession. So when people talk about a recession, they think that they're using the old paradigm. The old paradigm is things slow down and the demand gets hit. So things slow down, demand gets hit, and then we go into a contraction. I don't think this time is like that. It's different. The reason is we have a lot of things that are slowing production. We've got shortages on the supply side. One, that's going to be inflationary. And two, it's going to screw up GDP numbers. So you could have a very strong economy, but if it's choked of its inputs, things are going to they're going to become more expensive and your GDP is going to go down. It's going to look like we're in a recession. So then the question is the recession a form of weakness, or is a recession a form of constraint? I think it's a form of constraint because I think we're early in this mix of having so much money in the system, and the imbalances in the housing market are quite great. So I think that we are early, and I think that we are constrained in the system. That it's not necessarily it's not from a position of weakness, it's from a position of strength, and then we've got problems in the system. But that's debatable. That's debatable, and that's my opinion on it. And this is how all these things kind of tie together. And I didn't use all of the data. I used, some ones that I wanted to cover, maybe some ones that I don't normally cover, but they're all saying the same thing. Commodity bull market, inflationary period, and they're all agreeing with each other. We've got confluence. So that's what I've got for today, guys. If you guys like this kind of content, give me a thumbs up. Subscribe to the channel, subscribe to the website, Platinum membership. We've got a question and answer session Sunday, which will be today. It's going to be at 5 p.m. Mountain Standard Time. If you want to join up. The way that you can view, you can join the Zoom chat. What you want to do is you want to go onto the website. You want to go to the search bar, or just go onto the website. Actually, I'll do it right now. Let me get on here and do it for you guys, so you can kind of see if you want to join. So the Finding Value website here. Actually, maybe I should get myself out of here real quick. It's the first thing when you join. It's the first one. at the top if you're a platinum member. Zoom question and answer session, Sunday, 7:31, 5 p.m. You click on the link, and then you click on this Zoom bar there, and then you can get in. So that's what I've got there, guys. We'll see you at the question and answer session if you're interested, and we'll catch you next time. This is Finding Value.